I recently filmed this video on how to do a successful walkthrough with a property seller in this exact location about 6 weeks ago. If you go back and watch that video, you'll notice that the background here is kind of different, and that is because we just recently wrapped up the full rehab of this property, and we're in the process of furnishing it so that we can do a short-term Airbnb rental here. As I was thinking about the transformation here at this property, I realized that this is sort of the ideal type of property that we target. And so I thought it'd be cool to do a video here where I talk about this specific deal and I go through sort of an overview on how we found the deal, how we negotiated the deal, all the renovation choices that we decided on, and then ultimately how we're going to rent this property out to hopefully make lots of income for a long time to come. So if you're excited about this, give me a thumbs up, hit the subscribe button so that you can be in the know when I release videos, which I release on a weekly basis. I'm Kirby Atwell from Living Off Rentals, where we believe high quality rental properties are the best investment a person can make. So starting off with how I found this property, this was actually an off-market deal that came through a Facebook ad that directed the seller to my website where he filled in the information on the property that he was interested in selling. And so I created this video recently that explains that whole process of how I bring in leads through Facebook ads. So if you're interested in setting that up for yourself, you can check out that video. This property was actually a rental property previously. So the old owner had it rented out as a long-term rental. The previous owner's long-term tenant moved out about a year ago, and they left the property in pretty rough shape, and so he decided he was going to rehab it and then rent it again, but he got about halfway through the rehab and decided he just wanted to get rid of this property. So the problem is that the properties don't show real well when they're only halfway completed, so it sat on the market for a while, and he reached out to me, and so I came out and I took a look at it. I did a walkthrough with the seller, and he told me that he wanted $50,000 for this property. So I told the seller that I needed to check the comps in the area and do some calculations, and after I did my calculations, I went back to him and I offered somewhere around, it was either $32,000 or $34,000. And he told me that his bottom line number was $45,000. So we were at a little bit of an impasse, and we talked further, and eventually we came to an agreement that I could purchase the property for $44,000 if I hired him to do the roof and pay him $5,000 for the roof, because the old owner was a contractor. And so this sort of was a great compromise, and it's something that I always try to look for, some sort of compromise like this, because it got him closer to that $45,000 number that he was stuck at. It got me a lot closer to my number, which, you know, the net purchase price was really $39,000, because I was gonna have to hire somebody to do the roof anyway. And it also gave him some work as a contractor. So it was this great compromise that really worked out for all parties. The second component of this deal is deciding on what level of renovation we were going to do here. So this area in particular is pretty interesting because, you know, it's sort of a working class area with affordable housing and low taxes, but at the same time, you've got the beach, the Lake Michigan beach about a half mile from here. You've got a really big outlet mall. You've got an upscale casino not too far away. You've got wineries and restaurants in the area. So there's a lot of draw here for people from Chicago or Indianapolis or Michigan just to get away for a weekend or a few days. And so it's a sort of a perfect place for a short-term rental. I love a mixed area like this where you've got, you know, $1 million house on the beach a half mile away, and then you've also got really affordable working class housing in this area. You know, I think that is where you can find the best opportunities. So if I would have rehabbed this property as a long-term rental, I would have put about $25,000 to $30,000 into it, and I would have done it pretty basic, and it would have rented for about $950 per month. However, I decided to make this a short-term rental, And I'll talk in a second about how I came to that decision. But with all of the renovations that it took for a short-term rental, you know, the higher end renovations and the furnishings, and then some unexpected drain tile that we had to put into the basement because we found out we're on a higher water table level here, it ended up costing me about $55,000 for the renovation. So that brings me to the last component of this deal, and that is how we are going to operate this property going forward so that we can maximize its value and create cash flow for many, many years to come. I've said many times before that I always look for outsized returns when it comes to deals. And that just means that I want to have the maximum amount of cash flow and equity for the least amount of cash invested into a property. So, and obviously, and still have a decent asset. I don't want to buy in slums and be a slumlord just to maximize the cash flow. So when I'm analyzing a deal like this and I'm deciding whether to make it a short-term or long-term rental, I'm simply looking at cash flow to dollars invested. So for a long-term rental, as I mentioned, the rent on a monthly basis would be about $950. And that's on an all-in cost of about $64,000 to $69,000. And the house would be worth about $105,000 to $110,000 once it's all rehabbed. So that's not a bad deal at all. However, as a short-term rental, this property here should rent for about $90 per night. So conservatively, if I estimate that it will rent for 20 of the 30 nights per month, that means it's going to rent for a total of about $1,800 per month. Now, I think the short-term scenario is a much better scenario for several reasons. The first of which, the rent to all-in cost ratio is about 2%, which is about double what most people use as a general rule of thumb when they're purchasing rental properties when they use the 1% rule. And yes, I know there's extra costs that are involved with an Airbnb, like increased management costs. You're still gonna have to pay the utilities as the owner. You're probably going to have to pay for lawn care. So there are some extra costs, but there's a pretty big buffer in there with the 2% rule. The second reason that I think this particular property works really well as a short-term rental is because the value of the property after the short-term rental type of rehab that we've done is going to be about $125,000 as opposed to $105,000 to $110,000 that I would have gotten out of a long-term, more basic type of renovation. So we still maintain about the same amount of equity in the property, even though we had to put a few more dollars into it up front. But if I ever want to tap into that equity, it's much easier in a short-term rental because it's going to be staged, it's going to be cleaned several times a week, it's going to be kept in tip-top condition. So I could just put it on the market and it's all ready to sell, as opposed to a much more difficult process if I've got a long-term renter living here in the property and I've either got to evict them and then do some touch-up work to get it sold, or I've got to try to sell it with a renter in place. So the final reason that I like this property as a short-term rental is a reason that a lot of people don't consider when they're first starting out. It's something I didn't really think about when I was getting started, and that is that every property you own represents a new set of challenges. It also is a percentage of your energy and your effort that you're going to have to dedicate to that property. As I've grown my portfolio over the years, I've tried to stay really grounded in why I started to do this in the first place. You can always make more money, and it sounds really cool to say you've got 1,000 doors of rental properties. However, I would actually rather have less properties that are super highly cash flowing and take up less of my time and offers me financial independence, which is the whole reason I got into this in the first place, than I would having a whole bunch more headaches. In my opinion, quality of life should be one of the top factors in your calculation. So if you can get to financial freedom with less headache and more cash flow, then why not take that every single time? Also, because I'm not doing a massive quantity of deals, my family and I were able to spend the month of March in Miami as opposed to here in beautiful Northwest Indiana in March, while my contractor did almost this entire project while we were gone. We connected on FaceTime every other day, and he basically knocked it out. Now, there's no way I would have been able to do that if I had a massive company where I'm doing tons and tons of deals. So to recap the numbers on this deal, the purchase price, again, was $39,000. The renovation costs with the additional drain tile that I had to put in was $55,000. So my all-in cost was $94,000. Now that all this renovation is done, we can go to the bank and we can refinance the property. And the bank will give us 75% of the appraised value. So at a value of $125,000, the bank will give us back $93,750. So that means our all-in cash investment into this deal is about $250. So what does that $250 get us? Well, it gets us about $30,000 of equity between what the bank financed and what the property would sell for. Also, since our monthly financing cost will be about a total of $650, and that includes principal, interest, taxes, and insurance, there should be a spread of about $800 or a cash flow of about $800 on a monthly basis going forward. And that takes into account the extra cost of our utilities and our lawn care and our internet and the management. So let's just say we were able to accumulate 10 of this exact type of property, which just happens to be how many Fannie or Freddie loans that a person can take out. We would be looking at an all-in investment of almost nothing, and we'd have about $8,000 per month going forward on a continual basis, and we'd be sitting on about $300,000 of equity. So that's not too shabby of a situation to be in. So hopefully this video was helpful to you as you are considering your own future rental property purchases. The fun part about this business is coming up with creative strategies to increase your ROI. So remember to think outside the box. If you got something out of this video, I'd love to hear your top takeaway in the comment section below. Also, hit subscribe so that you don't miss out on future weekly videos that I release. Also, I'd love for you to join me and the rest of the community in the Living Off Rentals Facebook group, where this conversation will continue. I hope to see you there, and I will see you in the next video.